the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the Teaching Tax Flow podcast, everybody. Episode 82. We are jumping into how rental properties are taxed and maybe how they're not taxed. We'll see how it goes. But before that, let's take a brief moment as always and thank our episode sponsor.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, REPS, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the Reps Tracker sign-up page.
Welcome back, everybody. Today, as mentioned in the intro, we are going to look at rental properties and how they're taxed. So a lot of people have this idea, right, of, oh, I want to own all these properties, these houses. I want to be a landlord. You hear a lot, right? But how familiar are you and others with how that actually relates to your tax situation? So, as I always like to poke fun at, but nothing's rolling off the tongue today, so we just bring him back on here anyways. Chris Pacuro, the man with the answers, the tax guy. What's happening?
How are you today, Johnny T?
Oh, I'm feeling taxy. Feeling very taxy today.
Oh, Lord, have mercy.
There we go.
But I'm not feeling so taxy. I feel good. I feel I'm excited to talk about how rental properties are taxed. Obviously, there's some wrinkles, so we're going to be talking about the 99% situations. And you're right. A lot of people become landlords, property owners. Landlord's kind of one of those terms that, it's not too PC anymore. But investors or what have you.
It felt weird saying it. Honestly, like it didn't feel right. I said landlord. I thought, like I kind of nestled down in my chair a little bit when I said that.
That's okay. And some people become property owners, rental property owners, purposely. Sometimes we have an accidental landlord, or meaning, hey, you lived in a primary residence, you had an unexpected job change, you don't want to sell the property, you think you'll be back, or maybe you're in the military and you go overseas for a while, so you rent your property out when you're out of town or living somewhere.
Hey, well, that's how, Chris, this story a little bit more. That's how I got into the Airbnb game about 13 years ago, right? I didn't even have any pictures on that listing. It's like, what in the world did I just do? I had no idea what I was doing, but figured it out. So thank God for people like you. You can, make sense of the muddy waters when sometimes people don't know. But then also what we're going to talk about here too, Chris, are we going to look at anything between long-term and short-term rentals, or are we just kind of putting them all together?
We're going to put them all together. I'm going to say this. There is something, and we had another episode on the short-term rental loophole. There is a 1% to 2% situation where you are providing substantial services, according to the IRS, for your short-term rental property. That is extremely rare. If that's the case, what we're going to talk about today does not pertain to you. We're going to be talking about the 99.9% of all rental property situation, how rental properties are taxed and how you report them on your tax return. We talk, John, a lot about tax agencies being your involuntary business partner. In Teaching Tax Flow, we talk about that tax laws are written to encourage and discourage certain behavior. We also have an episode that not all income is taxed the same. Shameless plug. I think it was like one of the first 10. I don't know.
Go back and listen to those. That's when our audio quality was subpar. We were just so excited to talk about those things. But
well, when you launch a podcast on a used pizza box, what do you expect?
Disclaimer, but not a disclaimer. Yes, that really did happen. And go back and listen to some other episodes, and maybe if somebody tells us what episode we talked about that in great length, maybe we'll send them a little gift or something.
Send them a pizza.
There, yeah. But we'll send you a gift card for Domino's.
So why being a property owner, a rental property owner, is attractive is that the first thing I want to talk about when you're reporting how this income is reported is that you are paying tax on your net income. No, there are a lot of rules, what are called passive activity loss rules, and there are situations where on paper you can have a loss from a rental property that actually offsets other types of income. But the thing you have to remember is you're paying tax on your net income and not your gross income when it comes to owning rental property. So you report your rents collected, and you get to deduct all of the ordinary and necessary business expenses for a rental property owner. Those are going to be your mortgage interest, association dues, property taxes, potentially property management fees, repairs, maintenance, all of those common type of expenditures.
Not your dog food if you're a freelance graphic designer.
No, not in your case, John.
As I'm looking at a birthday card here from my daughter from a couple weeks ago that literally says, "Happy birthday, Dad," and it has a giant donkey on it. So I don't know if she's calling me a jackass already or what the deal is, but animals. Actually, there's a lot on that topic too when we talked about 1099s and dogs. So
absolutely. I mean, there are rare cases where you could deduct the dog food if you own like a junkyard or a scrapyard and in a area that's, let's just say, not the best area, and you have pit bulls that live there and they are used for security purposes only, they're not personal pets, they actually live outside, then that could be a deduction, potentially. But we're talking about rental real estate today. The other deduction you get is depreciation. Now, we talked a little bit about depreciation when we did our cost segregation study podcast, but what depreciation is it can be a confusing term for taxpayers. Because when you buy a property, why are you buying a property? So it appreciates, so it goes up in value. So depreciation is just a condensed term that we use to describe the cost recovery of that property. So for instance, John, if you bought a rental property that is worth for $200,000, let's assume $40,000 of that property is allocated to land. You want to look at those property tax records to determine that. And $160,000 of that property is allocated to the building portion. You depreciate the building portion, meaning you get to deduct that. And on residential property, that's over a 27.5-year period. Commercial property, 39 years. The point is, even though the property is going up in value, if you have a mortgage or don't have a mortgage, you still get the depreciation deduction, and that deduction can offset your rental income. So the first thing to remember when you're reporting rental property, your takeaway from this piece, I get to pay tax on my net income, not my gross income. So that's a win. Now, most people own rental property individually or in a single member LLC. Shameless plug for episode 2. Actually, don't listen to it because you would probably cringe. Although that's one of our most popular ones.
It still holds the number one spot for the most popular, I think, for 2 reasons, right? One of them, I think, is I purposely tried to get you all fired up on it because you as a tax pro, right? Like, and we'll get into this, I'm sure, as maybe some of the, we'll call it a disillusion, maybe with LLCs. But then also, yeah, this is just a great topic. And again, looking at our roster here for the upcoming month and a half, we're actually going to revisit that one. So shameless plug to subscribe to the podcast.
Yes, please do. But if you own the property individually, or if you own it in a single member LLC or what's called a qualified joint venture with a spouse, that property is reported on what's called a Schedule E. Schedule E is just attached to, in this case, your personal tax return. And the Schedule E just really breaks down many things about the property. Now, most people are focused on, am I reporting the proper amount of income? Am I reporting the proper amount of deductions? But there are other things the IRS is very, very interested in. And not only is the IRS interested in when we're talking about rental property reporting for that individual or single member LLC that's reporting on Schedule E, lenders are very, very interested in what's on this. Underwriters. In fact, our friend of the show, Brenna Carls from the Mortgage Shop, talks a lot about understanding there are things on your Schedule E that play a role in your lendability that you're not even thinking of. So let me explain that, John. On Schedule E, you have to identify each property separately. So if you own 10 properties, you have 10 different entries on Schedule E. Each Schedule E, you could put up to 3 properties on. You want the physical address of the property has to go on the form, but also property type. So you have to tell the IRS, is this a single family home? Is it a multifamily home? Is it commercial? Is it a self-rental? Is it a short-term or vacation rental? That's very, very important. Or is it just land? Because if you have land and you're taking a depreciation deduction, shameless plug to our previous podcast. We're going to do a lot of shameless plugs today on the IRS data book. Your examination percentage is probably a lot higher than we just talked about last episode. So that's a factor, because if you're going through underwriting and you're trying to add to your portfolio, the type of property plays a role. Also, you have to report fair rental days versus personal use days. So we see this sometimes where someone is lazy, or our tax professional is lazy, or the software just defaults, where you may have bought a property. Let me give you an example. You bought a property in October. You placed it in a service. You report the rental income. On your tax form, you put down that you owned it. There was 365 fair rental days. What's the problem? An underwriter is going to say, well, if this property produced $15,000 worth of revenue in all year, that's not very good when our debt service is a lot higher. But if the underwriter or bank says, oh, okay, you only owned it for 90 days and it produced $15,000, then they can surmise that it might produce $60,000 a year. So my point is, when you're reporting on Schedule E, we talked about those technical parts about it previously. Make sure that you properly report the fair market rental days, the personal use days, in the property type.
And here's a dumb guy question, from me, as I always try to have one of them, or I try not to have them, but I do. So I'm actually looking at a Schedule E here in front of me, right? And the lines, where it comes to, listing each of the physical addresses for each property, so up to 3. You have those columns: fair rental days, personal use days, and then there's that little column with some checkbox. It looks like it's QJV. What exactly is QJV?
There are a couple check boxes that you have to be keenly aware of. QJV is a qualified joint venture. So if you live in a community property state and you and your spouse form a limited liability company or an LLC, and you put the property in the LLC or a partnership, let's say, in general, you would have to file a partnership tax return. And those returns on average start at $2,000 a year to have those prepared. And then you issue K-1s. We're going to talk about that in a moment, but let's just put it this way. Then your tax compliance is a lot more arduous. So instead of having to go through the process of filing a partnership return, if you qualify, then you report to the IRS, hey, this is a qualified joint venture owned by both spouses on this tax return. That's why, IRS, I'm not filing a partnership return for this property. The other boxes, great observation. John, I'm so proud of you for looking at the Schedule E.
Hey,
are you going to go to the eye doctor later?
Every once in a while,
eyes bleeding.
I closed one eye and kind of looked at it like, see what this thing is right here. I hear schedule and it reminds me of high school and college days where I didn't like it. Because kind of it.
Yeah, I know you're a loose cannon, John. You don't like you don't like having a schedule. Although you really don't like when people are late, and I love that about you. That's one of your big pet peeves.
Drives me nuts. I won't mention. Let's not get off topic. But now you got me all flustered up. It's kind of like when everybody says that I'm a 1099 employee. Kind of what you said about that. So I know that gets you flared up. It's
good segue though, because the last question that is on the form is, did you make payments that you should issue a 1099 on? So if you're a rental property owner, the IRS now says, hey, should you have issued 1099s? It's a really funny question, and you either say yes or no, and then they ask you, if yes, wait, did you make any payments that would require you to file a 1099? Yes or no? Let's say I say yes. Hey, if you said yes, did you file them? I've yet to see a tax return where someone said, yeah, I did. I did make payments for the 1099, but yes, screw you. I'm not filing one.
One day, Chris, we're going to put the call out there. If somebody has so much money that they don't know any better way, thing to spend it on except pay fines to the IRS, we should try to, find that person and just try to, muck with the IRS as much as we can by contradicting answers and, timing how long it takes to get an audit. So if anybody wants to do that, I'm sure we can oblige.
Well, let's move on to the second popular fact pattern when you own property. Assume the property.
I like how you completely kicked my BS comment to the side. You're like, no, I don't want to work with that person. No, I want nothing to do with those returns.
No, heck no. And the people in the teaching tax flow community appreciate that. The other tax professionals.
Anyways,
well,
back to a regularly scheduled program.
I didn't even acknowledge pivot redirect. I just pivoted and redirected on that one. So that's just the way it goes. So let's talk about reporting for someone that has either a multi-member LLC, taxed as a partnership, or is a partnership, or, is an S corporation, which is going to make our tax professional friends cringe when you have rental property in the S corp, but we're not going to get upset. But let's assume you own rental property in one of those three types of entities. The multi-member LLC and the partnership, that is reported on a Form 1065. An S corp reported on an 1120. Yes, there are episodes in the podcast about these forms. Regardless of if you're an S corp or taxed as a partnership, the rental activity, other than being on the balance sheet, is reported on a Form 8825. I want to be the person at the IRS that gets to number these forms. Like, wow. Very interesting. We need a new one in the 800. I'm sure there's a method to their madness, but like 88, we've got a gap. Let's just call it Form 422 or something.
Right. Yeah, because I highly doubt they have, 9,000 forms.
It feels like it sometimes, but although I know what you mean. So the 8825 really sets up similarly to the Schedule E. But this is, you have to report the fair market days, the personal use days, what type of property, the physical address of the property, gross rent, and then your rental real estate expenses, including depreciation. Each Form 8825 has the capacity for 4 rental properties to be reported on it, where Schedule E only has 3. So if you have 12 properties, not a big deal. I mean, we shoot on the private CP practice, we've got clients with over 200 properties, and we have 50 Form 8825s attached to the partnership return so that happens. But so the 8825, again, make sure you take your depreciation deduction. The difference on the partnership and S corp return is that you have to report the balance sheet, which would mean any mortgage amount, any asset amount for the entity. So yeah, very similar. And the takeaway here is, remember, each property should be reported separately. Now, there are some exceptions to that. An exception might be like an apartment complex or an apartment building that has 20 units in it. You're not going to put each unit separately. That apartment is its own, physical address. Or if you have a duplex, duplex with multiple addresses, like it could be 110-112 Main Street, could go on one line. So make sure, because it gets really muddy and the IRS doesn't like this, and nor do banks. And I've seen it, unfortunately, where I see someone that has 8 rental properties and they put it all on one line of their Schedule E and they just slap in their rental property portfolio. That's not a good look, John.
Nope.
It's not a good look. So
I can see
there are
exactly
a lot of
why.
reasons for that that go beyond this podcast with passive activity losses and rental grouping elections and that sort of stuff.
Absolutely. So I know in the, early on, one of the first kind of supporting documents I know we made with teaching tax flow, and this was probably going back about a year and a half, we laid out all of I think we call it a guidance chart, right? So we laid that out as far as for a really kind of a cheat sheet on entity types, or I should say ownership types, whatever, for rental properties. So do we want to walk through all these kind of one at a time? And some of them I know are very simple, but then also too, and I know this is probably going to come up again, I know we talked about it a little bit too, is I'll let you do the answer for it, but somebody that might be looking to getting their first rental property, or maybe reassessing their situation.
Mm-hmm. Yeah, absolutely.
So an LLCs. So LLCs with properties, though. I'll let you explain what it really is and why the IRS does or doesn't care about an LLC.
Right. I mean, a single member LLC is a disregarded entity. So remember, if you have a rental property, it's going to fall into 3 buckets. The first bucket's going to be you own it personally or you own it in a single member LLC, or you own it in a qualified joint venture. I would say that's going to be the vast majority of rental properties. Then it goes on Schedule E, part of your personal tax return. Bucket 2 is going to be that multi-member LLC or partnership return or S Corp. Cringe every time I think about rental properties in an S Corp. Then those properties are reported in Form 8825 and go on your partnership return. I know we're getting really in the weeds and technical, so what I want people to remember is work with your tax professional to make sure that you're getting the depreciation deduction and make sure that each property is not only identified as the correct type, but the correct rental days, and each property has its own line on those forms. And then finally, if you own a rental property in a C corporation, very rare, then there's no separate schedule or form. You just put the rental income on line 6 of the C Corp and list any deductions as normal on the C Corporation tax return. That's a Form 1120. I would say at least in my 20 years, if I think about all the properties, 1 out of every 1,000 properties are on a C Corporation tax return. Very, very rare.
Excellent. So yeah, there's complexities with certain situations and certain setups, we should call it, but hopefully this, gives everybody a little bit of a background just in the separation, right, Chris?
Yes, and I would say if you are listening to this podcast and you're newer to our podcast, definitely go back. And I know we kid around about the shameless plugging. Listen to the podcast on Step Up and Basis. So if you are listening to this and you're a tax pro or you're a taxpayer and you're working in rental properties and you realize the property was inherited by someone, definitely think about the Step Up and Basis and make sure that that's accounted for within that depreciation deduction.
Chris always says, you're kind of pardon the shameless plug. Not me. Nope. I will give the shameless plugs and they are completely shameless. So yes, that episode, Chris, that's actually a really good one to mention too. If somebody's not familiar what Step Up and Basis is, myself included, honestly, even going into that podcast, listen to that. I won't say anything about it, but listen to it, but you will be absolutely floored on the opportunities and benefits with that. So, and then also too, looking at our podcast recording roster, directly tied into rental properties. Again, if this is something that you're kind of interested in, maybe you haven't acquired your first property yet, you're thinking about it, kind of kicking the can a little bit. I believe it's the end of June. We have an excellent topic on why real estate is so popular when it comes to taxes with a fantastic guest who, if you've done any research online about real estate investing, his name has definitely come up. Won't tell you who it is because I like dangling carrots. So hang out for it. Subscribe to the podcast. Check us out online. We are happy to obviously craft some content to help you in your real estate investing journey. So as always, we will see you back here next week. Same time, different topic on the Teaching Tax Flow podcast. Everyone, thanks for hanging out with us again here on the podcast. It's hard to believe that we've done this 82 times. That's 82 weeks. If you've listened to all of them, we commend you. You've obviously been along for the podcast journey that Chris and myself have gone on. Yes, we started this on a pizza box, which we're not ashamed of. Lavalier Mike and I fell into a pizza box. We said, hey, today's the day we're going to launch a podcast sitting at a dining room or living room table, sitting on a sofa in Panama City Beach, Florida. So if we can do that, you as a taxpayer can take advantage of some of the benefits and opportunities that are out there. So I know I sound like a used car salesman, but nothing against car sales. But check it out. I mean, as we mentioned in this podcast, often and very often, you, the taxpayer, really are in control of your tax situation, your tax bill per se. But it's, again, it comes with responsibility. It's up to you. You're in control of it. But that being said, you need to be educated, be working with the right team in place. We did a great episode earlier on. Yes, another podcast plug about building your board of directors, personal board of directors. So check that one out. Check out any of the topics we have on here. If there's anything you haven't heard yet, it's either already on the schedule or we don't know that you're interested in it. So drop us a line. If you have any ideas for shows you would love to hear, we'd love to hear them as well. So thank you as always, everybody, and we will see you back here very soon.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.